Welcome to Technologies Now, the Business Edge, the show where we sit down with entrepreneurs, real estate professionals, industry leaders, and we explore systems, strategies, and technologies shaping how modern business grows. I'm your host, David Urbach, and each episode is designed to give you real-world insights that you can actually apply, whether you're scaling a business, navigating capital decisions, or building smarter systems to support long-term growth. Today's conversation is especially relevant for real estate professionals and entrepreneurs who want to grow strategically, not reactively. I'm joined by Emilio Giliberto, managing partner at Alliance Capital Advisors. Emilio works with founders, operators, and real estate professionals to design capital strategies that support sustainable growth, helping businesses think beyond just getting a loan and instead focus on how capital structure impacts cash flow, risk, and long-term value. His background spans underwriting, structuring, portfolio management, yes, there's more, and capital advisory, giving him a unique perspective on how capital decisions affect businesses at every stage of growth. Emilio, welcome to Technologies Now, the Business Edge.
David, thank you. Appreciate the opportunity to chat and appreciate the very robust background and introduction.
Did I cover it all? I mean, you'll have a chance to tell your story. In fact, let's kind of start from the beginning. What is your story? How did you get into this business? You've worked obviously in many capacities, and it's given you a good perspective on business. So let's hear it, Emilio.
Sure. It's kind of interesting. I'm going to go back a ways. I'm not going to date myself, but I've been in the industry far too long. I have enjoyed it tremendously. I started out most of my career was in banking as a lender in various capacities. When I came out of college, I got a job initially with a small community bank that really set me up for understanding how to lend, how to get to know people. Community banks are very close to, people. Back when I started, there was a lot of character lending, a lot of art to lending. Wasn't just balance sheet and income statement. Obviously, as the markets migrated, we got more sophisticated, we got more scientific, but that's where I started. I really believed in those roots. I went from there into a large regional bank, got my real credit underwriting training in that field, and then moved on to the business development side of things.
Nice.
After working in small business and underwriting small, medium-sized and mid-sized corporates, I moved into the real estate world and did commercial real estate for about 10 years. Was smart enough to move in when the market hit the skids I won't say when, but it was the first time.
Okay. Yeah. Timing is very important.
Yeah, well, it allowed me to go out and get more credentials. I was able to get my MBA. I was able to get my CFA, learn how to underwrite a little more traditionally. At that point, banks consolidation was happening at a very rapid pace. So I was working for a large regional bank. They merged with another large regional bank. Then they merged again. Right. And I got tired of the constant having to fight for your job and having to, do all of that stuff. So I moved to a small boutique bank that started a trade finance group, international trade finance. And that's where I've been for, the last several years of my career. It actually led to me moving from Connecticut to Texas because
a culture shock, maybe just a little bit.
You know what? It wasn't. I'll tell you the interesting thing about that move was the bank here in Texas was owned by a Spanish bank. So it was really the first time that I was working for a corporate parent that was overseas, even though a lot of my business was international. So it was kind of interesting to have to deal with the cultural differences between the parent and the local bank. But it was a learning experience. It was a great experience for me. I was able to help them build a trade finance, and then they were acquired. Or the U.S. operations was acquired. So after that, I left. I didn't leave. I kind of actually was. I wasn't going to be employed there. They had their own management in place for what it was we did. So
right. Yep.
I
That's very
started a
common.
small advisory company, was hired by a firm that was looking to establish capital markets. I had some experience in receivables purchases and receivables finance, and they were working in tax credits, and I helped them put together a line of credit to purchase those credits. That ended after a couple of years. The tax credits expired, and there was nothing left to do there. So I started Alliance Capital with a partner.
Nice.
And, we have kind of developed our own way of doing debt placement. And it involves asset classes. We can do it pretty much all because my partner and I have touched pretty much every asset class that you can think of. And so we can do asset-based lending, we can do equipment acquisition, we can do business acquisition and real estate.
Excellent. And what do you focus on the most? You mentioned real estate, but it sounds like based on your background, in fact, that if that's not a perfect background for what you're doing now, I'm not sure what is. So
Yeah.
it's all led to this accumulation of your experience to, open shop here.
Yeah.
So what do you guys like to see? What do you like to specialize in? What would be your ideal client if it walked in the door?
Well, yeah. And that's a great question. So we define our ideal client as kind of the middle market. So, but everybody defines that a little differently.
Yes, they do.
We would look at deal sizes 2 million and up. Typically, the companies that fall in that, that can support a deal like that are those that have 10 million in revenues and up. We'll go down a little lower if we have to. If it's for a good client, the challenge always is with those deal sizes and especially the smaller deal sizes. At the end of the day, every lender is going to want to see some form of information. And we have to have clients that can deliver information to us. So we're looking for those clients that have a good set of books, can deliver the books. We can analyze those books. We can then determine the best path for them in terms of the debts that they want to use to foster growth or acquisitions or anything like that. When we're talking real estate, owner occupied real estate is great. We do investment real estate as well. The market really dictates, what can walk in the door today. Okay. If somebody's trying to get, and in some markets, office space is coming back. But, what we're seeing is that if it's office, if it's small stuff, you're generally getting some hesitation right now. So
A little
we
bit
will
nervous
look at,
about. Yeah, I
I'm
was going to say
sorry?
a little bit nervous. I was going to say a little bit nervous about how the office space has been, and there's been that giant reset. Obviously, we have seen that even in Denver. Some of the office buildings are getting leased up,
Yeah.
and others maybe still not so much.
Well, you're facing a trend in that market, right? That's difficult, and the trend is interest rates happen to have gone up, right? So anybody that was coming up on those 5-year renewals was facing the challenge of a higher cost for the loan.
Mm-hmm.
And then you had a situation where taxes were going up as well. So you really had that moment where you had to build in lease renewals, right? And the cost of rents were going up as well. So you almost had that perfect storm of everything going on at the same time. It looks like the interest rates have kind of subsided right now, so things are a little better. The tax end of it, not so much. But it seems that there's been, and it's in pockets. It's not in every market, but it's in pockets that we're starting to see some interest pop up on the office side.
Interesting. That brings me to what markets do you play in? What are you looking for, and what do you
Well,
what do
we're
you like?
based here in Houston, Texas. So Texas is a big market for us. We will go nationwide, and I think it's important to kind of reset a little bit here and talk about what we've done at Alliance in terms
Okay.
of our platform. So,
Yes, please.
we in our first year, we've spent a lot of time building out the platform. Our goal was to be able to service middle market companies, closely held companies, okay, that have one or two, maybe three owners, family owned, things like that. What we've learned is that those owners generally have other investments. So you'll see them being real estate investors, you'll see them running their companies, things like that. So we fill that bill for them in a lot of ways. What we did was we said, okay, most of these owners, most of these investors, unless they're in the real estate market, for instance, 100% of the time, they're going to know who lenders are. But if it's somebody that is, say, a business owner, they know their business very well. I'm going to make my widgets. I'm going to know how much it costs to make my widgets. I know who's going to buy these widgets, right? Now, all of a sudden, they're growing and they're saying, I feel like I'm poor because I'm experienced this growth and, the money's just going out the door, right? Because you're growing, you got to buy inventory, you got to do things like that. And so financing needs tend to sneak up on these owners. And the immediate thing they tend to do is they do, what are you going to do? I'm going to Google, lenders, right? Or I'm going to go to my bank.
Yes.
And you go to your bank and the bank says, we love you. We love your deposits. We like who you are,
right,
but you're not quite where we need you to be. Or, your industry is not exactly what we like to lend to, things like that, right?
Yeah.
So then they go in and they say, okay, fast money. And they get some fast money that doesn't meet what they want to do, right? It starts sucking money out immediately. We've seen, a recent trend where you get this 24-hour money. You say you need $1 million, but you don't get the full million, right? They pull their fees out of it. They pull everything. And then all of a sudden they're hitting your account on a weekly basis. And that doesn't help you, right? It solves your immediate need. But then what happens is you got to load another loan on to start paying for what it's taking out. So
oh my gosh,
what we did was what we did was we built a platform that, number one, we're gonna put your numbers in. We took full advantage of AI. We built algorithms into this thing, and we said, okay, now we can assess where the company's coming from. Now those algorithms, those assessment, that's incorporating almost 50 years of experience between myself and my partner when we built it.
Nice.
Okay. So the beauty, in my opinion, of AI is taking that experience and building it in. Okay. If you just solely rely on AI, it's garbage in, garbage out, in my opinion.
Absolutely.
So what we do now is we do what we call a capital assessment when they walk in. And that capital assessment breaks down all of their business components. What are their revenues doing? What are their costs doing? Things like that. There's always a debate. You can find us on LinkedIn every day. EBITDA, is it the right way to measure somebody's ability to repay, or isn't it? Well, you know what? Whether we like it or not, that's what the lenders use. And so...
right. We have to play along.
I'm sorry?
We have to play along with what the lenders use, right?
Exactly. So we're going to assess that. And then the other component, and we give this to the borrower when the prospective borrower, is, what are your assets? Okay. And how can we build around those assets? So it becomes, how's the company doing? And then, do you have assets that we can use as well? And I'll give some examples a little later. But the bottom line is, that's the first step, right? We want to see where the company is. And then we want to see, how are your debts structured? Are they meeting the way your company operates and the company drives cash flows? And if you're not, you're going to find that you're going to end up in trouble, right? If you're a transactional company, meaning you buy something, you do a little something to it, and then you sell it, but you took out a term loan, the minute you sell it and you're still paying the term loan, you're going to find that eventually that money that you used, now you're not going to have it for the next contract you win or the next deal that you win, right? So you want to make sure that your lending matches the way your money flows. So when the money comes in, you pay off your debt, you're delevered, and then you can borrow up again on the next one.
That makes perfect sense, because if you can't match your cash flow, you can't pay it back, and you end up in this spiral. I would think a death spiral eventually.
Yeah, exactly. So, our component is this capital assessment looks at those risks and it says, okay, now who's the best lender for you too? So the other component of our platform is, we've got lenders. And so we look at your capital assessment and we say, you've got a lot of receivables. We're going to find you an ABL lender. We're going to find you a factor. Okay. Now, the other side of it is what's going on in the market. Everybody we all want to go and get a loan from a bank, right? It's the cheapest form of capital out there. The problem is when the banks don't lend, what do? Well, we have this wonderful private lending market that's burgeoned, right? So our portfolio of lenders includes both traditional bank lenders and non-traditional lenders. The beauty of the non-traditional lenders is they can be faster. They know how they're underwriting. They know exactly what they're doing in terms of, and it's not that the banks don't, but they know they just have a process in place that moves quickly because they're highly specialized in what they do. To get to a bank, you got to migrate to the right group. Is it an ABL group? Is it a term? Is it the equipment group? Is it? And your relationship manager has to be able to manage that and find that. Whereas what we do is we act as your relationship manager in a sense, and we say, okay, it's an ABL loan you need. Bang, we're going to find you an ABL lender. And there are banks out there that specialize in that. And we know those folks. If you're going to meet their criteria, that's where we'll place you because we know that that's the most effective cost of capital. So it's a balancing act to find the right match for the right company.
And I think at the right time as well, right? So
Sure.
when are they coming up and finding, alliance? Are they finding you at the right time? Is it a little too late? Or what do you see and what guidance would you give to a company that's, knows they need to restructure what they're doing?
Here's in all honesty, generally, initially, what we were finding were people that were coming to us when they were desperate. Okay. Banks kicking them out. They've had a hiccup of some sort, or they just can't seem to figure out which way to go. Or some of these people have taken on the wrong kinds of loans. Sometimes, sadly, there's really nothing you can do at certain points in time. My recommendation to somebody, especially at this time of year, a lot of loans are coming up for renewal. It doesn't hurt to come talk to us. We offer free capital assessments. Okay. So there's nothing being signed. There's nothing being required other than financial information. We can look at what you got and we may be able to say, hey, that works for you, stay in it, or here's the risks you got and here's what we can do for you. The issue in this industry, especially when it comes, we call ourselves debt placement agents, but at the end of the day, everybody says you're a broker, right? And there's always a negative connotation that comes with that. But the reason why we have the name advisors in our name, in what we call ourselves, is strictly because we build an advisory capacity into what we do. That's what the capital assessment is all about. And so our goal is to look at your capital structure and say, is there a way we can improve it and reduce the risk to your company? A prime example would be we had a client who came to us and said, this loan is killing me. Okay, I need to get out. And he was talking about getting into what they call a revenue-based loan. So he was in a factoring line. And, I said, okay, let us look at it. We did the free capital assessment. We looked at it and we said, you're in the right product. You're just using it wrong.
Interesting.
And he was under the impression that he had to factor all of his receivables through the line. And he had a client that was paying in 3 days. And factoring a 3-day client makes no sense. And of course, they were getting a collection fee for everything they were collecting. So he was paying $20,000 to factor his biggest client who was paying in 3 days, and he was paying $20,000 for collection fee. So he was getting charged $40,000 to run that through. And I said, you can take that client out and not factor them. I said, what they're telling you is if you factor one receivable from that client, you got to factor them all. I said, you don't need to. You're getting paid in 3 days. And so he saved $40,000 just from our analysis. Now, unfortunately, we didn't make anything on that, but that's the kind of assessment we do. We could have put him in a revenue-based loan and that would have strangled him. Okay. He was in the right product, just using it wrong. And if that factor actually required him to factor every receivable, then we would have pulled him out of that line and put him in one that didn't.
Excellent. That makes sense. And this is this is out of your system, or you automatically knew this just based on your experience? Or tell me about your process. Someone reaches out to you. Where do you start? What are the first questions you ask?
So it's I guess we can break it down into a 3-step process, right? It starts with the capital assessment, and then it goes to and honestly, let's break this down into different asset classes. So this is for commercial lending, right? This is
Right.
for if somebody comes in is running a company, what do you do? And then real estate's a little bit different, right? Real estate is assessing different risks. So let me start with the business loan process. We do
Okay.
a capital assessment. We'll take your financial statements. We can do this with 1 year. I need to know who you're borrowing from and what the terms of that are. And then we plug that into our system. And what our system comes back with is it'll give you some nice charts and graphs, right? Everybody loves charts, graphs, or,
They do. Yeah.
colors, all of that wonderful stuff. And it basically
Right.
says, hey, this is where your profitability has gone, right? So if you give me 3 years, I can show you what's happened with your profitability and what's affecting that, right? Your revenue's growing, they're shrinking, your costs are growing, they're shrinking, right? Most owners would know that, and they can talk to me about what's happening there, right? Then it goes into how is your working capital structured, right? You got your current assets, your current liabilities, and what's fluctuating in there. Typically, what we'll see there is are they using the right funding or the wrong funding for things? Because what you might see is a lot of short-term loans, okay? And you'll see all of this equipment down here, and you'll have negative working capital because they will have borrowed off of lines to buy equipment. Okay, it's a huge risk because the minute they call that, you can't do anything. So one of the things we'll do, and we had a client where we did this, is we had to reset that, right? We had to pull the equipment, we had to use that to refinance and get their working capital back in order because they didn't have enough room to buy for inventory or things like that because they used it to buy equipment. So, that's part two, right? We look at that kind of risk. Then we look at, kind of tipped it off, right? The assets. What do you have? You have accounts receivable. How do you use those in the financing? You have equipment. You have real estate. How do you use that? Can we leverage that in a different way to get you what you need? Like sometimes we'll use the real estate to get a working capital line for them, right? It's just using the asset to support the growth in inventory and receivables. So we can do that as well. So it's just a matter of what assets do you have that we can use and to which lenders can we take this to? The other thing that we look at is, and the banks do this a lot, right? In their agreements, they'll have performance covenants. And that's what trips folks up a lot. We had a company that did glass. They kind of manufactured it a little bit. They had a line of credit. They never used it. And the minute that, they had some slowdown. And so they used the line of credit. And the minute they used it, they had to start filing reports. They had no idea that they were going to have to file reports.
No.
Filing reports, all of a sudden they tripped the covenant and the bank said, get out. And he's like, I've been with this bank for 10 years, never borrowed. Now all of a sudden I borrow and they're kicking me out. So, the beauty of the private lending market is they're focused on the asset, right? They'll give you an ABL line and they won't overlay performance covenants in a lot of cases. And so you won't get tripped up in that case. You won't get to the point where you're going to end up getting hurt because you had a bad quarter or two. And I don't mean losing money in a quarter. I mean just a quarter that was down compared to where it was. So you have a debt service covenant. It's set at 1.2 times and you're at 1.15. Right now the bank gets a little leery. They don't kick you out, but they get a little leery. Now it goes on for another quarter. It goes on for another quarter. They're saying, okay, you're not improving. So we got to move you out. We got to put you in special assets. That's typically what we'll see is when they're coming to us for that. The beauty of it is we have the options. We can get them out of the bank and we don't have to disrupt their banking relationship with depository movement and stuff like that unless they want to move to another bank. But at least we can find them a solution, particularly if those assets are of high quality.
Nice. That makes sense. So I want to ask, I think what is maybe an obvious question, but why doesn't every business owner know how to structure their finances, their debt, to put this all together?
So I've been in the business for over 30 years. A lot of it comes from experience and training. Every business owner is not trained on how to get a loan. Think about this. Well, let me ask you the question. If you had to go get a loan today, where would you go besides Alliance?
Besides Alliance, I'd go to my bank. It depends on what I needed. I mean, I might just go to my Amex card. I don't know. It depends on what it is.
Perfect answer, right? Perfect answer. So if I'm going to buy a piece of property, I'm going to go to a mortgage lender, right? I'm going to go to a bank. I'm going to say, hey, I want a mortgage on my house. I'm going to fill out an application. I'm going to give them my tax returns. and I'm going to wait and they're going to spit something out and say you're good or you're not good, right? Same thing, they think the same thing for a loan, right? They say, okay,
Right.
here's my tax returns from my company. Now, what are you doing with your tax returns, right? You're trying to limit your tax liabilities,
You sure are.
right?
Yes.
Right. So, yeah, you're inflating certain costs, things like that, right? Bank can't work with that, right? So you fill out the application, you take months and months. Now you think the bank knows you, you think that the RM knows you. You might even have a little line of credit with them, but you're growing, you need more. You got to ask yourself, I'm the widget maker, right? We go back to that. I'm the widget maker.
Right.
I'm not the CFO. I don't and CFOs, quite frankly, they're good at what they do in order to measure, where every penny is spent, how everything is worked. But when it comes to getting a loan, they're going to go to the same place. I'm going to go to the bank, right? And if the bank doesn't serve their needs or the bank doesn't like their market, now what? And you're going to go and Google it, right? So to your point, you're going to go to the place that traditionally we're ingrained to go, okay? But now you look at the residential mortgage market, right? Do you go to a bank to get a residential mortgage?
Not first. That's not my first step, but you could.
Right? You could, but where you can go on to what is it, lending.com or whatever it is,
Oh, you can go
Rocket
anywhere.
Mortgage,
Right. Very
Rocket
specialized.
Mortgage. You can
Yep.
you can find it all. That has developed in the private lending market. The problem is they're very specialized in the private lending market. So you might get an approval from somebody, but it might be the wrong loan. And you won't know it until you live it, because they're going to say, yeah, I'll give you a line of credit, but it doesn't work the way you think it does. So that's where my experience comes in. I have structured loans for years and years. And it's a very simple process, right? You get cash flow coming in, it pays back the loan. Okay. How does the company's cash flow come in the door? How do they get paid so that they can pay back the loan? And so it depends on the asset. You don't want to pay, you'll have guys out there that are capable of paying cash for their equipment, right? And that's all fine if you've got the excess cash flow. But if you want to take a loan, you really want a term loan to make that happen, and you want to kind of stretch that out a little bit.
Right.
So, that's the kind of stuff we do. If you're buying a piece of real estate, for instance, right, you're going to move your company in and you're going to have this piece of real estate, you're not going to go out and borrow that from your line of credit, right? It'll just choke your line of credit.
No,
you buy a
right.
$2 million piece of real estate, you got a $3 million line, it'll choke it off. Now, that's good if you want to do it temporarily, but then you come to us and we can put you in with a highly specialized lender. It could be a bank. Okay, we know community banks. They're great for that kind of stuff. There's SBA loans. They're great for that kind of stuff. SBA lenders are not only banks nowadays. They got people that are basically internet banks that are SBA lenders, and they're highly proficient.
That makes a lot of sense. So what advice do you give to an entrepreneur that has a widget and is starting their company? What should they be looking at that they're not looking at from the beginning, from your perspective?
So, starting a company, it's going to be really challenging to go out and get a corporate-based loan. Okay. So honestly, you've got to find a way to get some capital. And the way you insert capital is, and especially it's small businesses, right? It's personal lending. You're going to have to give, you're going to look at your house, get an equity loan on your house, right? You're going to have to take that risk. Raising capital has become a little bit easier. There's private equity out there now. Alliance really doesn't do a lot of that, but it's a different animal. And the private equity firms, you have to meet, like they're looking for a portfolio of assets. They're going to want 5 or 6 companies like you. And if they can fit you into their portfolio, awesome. But it's expensive. It's very expensive. So I would say to the entrepreneur starting out who's got the widget, who's got some sales going on, look at what you can do from a personal asset side. If you don't, bring in somebody somebody you trust to help you with money, okay, and to become an equity partner of some sort or a private lender, and you can buy them out. Okay. As the company matures and as the company starts to grow and there's a possibility, the company's showing profitability to the point where it can support debt, then I would say you come to us and we will try to fit you into the right thing depending on where your company's growing and why it's growing.
Okay, that makes sense to me. So it just depends on where they're at in their life cycle. Obviously, their own
Yep.
personal capital is going to be least expensive in general, I would think, or maybe the least easiest to get to. We'll just say that.
It's the one that keeps you up at night too, right? Because your house is on the line. So the business
Yes.
doesn't work, right?
Yeah, that kind of leverage is very close to home then if it's
Right.
your pun intended, of course. Yeah, with that. That's interesting. So then after that, it just depends on the life cycle of their business. If they need capital to grow and they can justify it, or you can help them justify it, if they
Hmm.
can afford it to expand or to continue operations. Yeah, your examples that you gave of their debt structure just being, incorrect or turn out to be correct, they're just using it incorrectly. They wouldn't
Hmm.
know this. They would absolutely not have any
Well,
idea how to because no one's coaching them along on this necessarily, right? They
yeah.
need somebody in
Well,
your court.
and he's relying on the person on the other end, right? I don't think there was any ill intent by the lender. The lender basically told them, if you finance one, you got to finance them all. But what he was referring to was the client. Okay. Each client is not required to be funded. He had other clients that were paying in 30, 45 days, and he needed to finance those.
Right.
But that takes his line usage down. And because of that, the flip, because they were charging a collection fee every time money came in, the flip was a lot less. So yeah, it's great. I can give you another good example, which is how we built an acquisition loan for a
Nice.
client. There was a
Okay.
client that was a general contractor, came to us, wanted to buy an actual, a construction company. The construction company was suffering a little bit, but it had more to do with personal finances than it did with the company itself. The company was unsolid, but some of these owners tend to use the companies as piggy banks for other things. And so they were pulling money out to make investments, and it was a
Bad
it just
investment.
turned out poorly. So this general contractor used them, liked them, and said, "We'll buy you out, and this way we can vertically integrate." Um, and they came to us, and they basically said, "Look, we're going to buy them for 8 million, but we want to delever, and we're going to need working capital." And so, we put them in the system. We did the analysis. We saw that one company was doing extremely well. The general contractor was doing extremely well. The other one was suffering because of the loans they took out. So we had to find a way to allow them to delever. They had real estate that really wasn't part of the construction company. So they needed a way to sell that real estate, but then they needed to delever that real estate and pay down the debt associated with it, if you will. So what we did was we broke down into three components. We said, okay, look, you're going to need a working capital line. So we built an asset-based line for them. There was a little extra money in there to go towards the acquisition. So in other words, we were able to get them a line that had availability of 7 million. Okay, so we used that towards the acquisition. So as those receivables paid out, the line would come down. Okay, which is what they wanted to do. And then they could borrow back up if they needed it for a job or something like that.
Hmm.
We had built that component in there. We saw the equipment, so we were able to put a term loan around the equipment. Okay, so that term loan was good because now that, as they got jobs, obviously they wouldn't have to pay that all at once. And then we put bridge
Right.
lending on the real estate. So they were able to buy the company for 8 million. They were able to get some working capital, and then the bridge loans could be paid off because they were interest only loans when they sold the real estate.
Oh, perfect.
Yeah. So we were able to meet their needs using the assets that the acquisition company had. Actually, it was kind of interesting. And so, they were real pleased with that. And, that's the type of thing that, our system can highlight, because we're looking at assets and we're looking at how they make money. And actually, we were able to look at the two entities on a combined basis to see where they would come out together. And it, worked out really, really well for them.
That seems like the perfect case study that you had there, and a project to work on. And I'm hoping it was profitable, but certainly it benefited this company greatly. Both companies, actually.
It achieved
So,
their goal, which was,
right,
we know we got to use debt, but we don't like debt.
right,
So it achieved their goal. And, from a personal perspective, they had one bank that was, asking them to pledge 401ks, just not
Just digging a
401ks.
little
They were
too
asking
far.
them to pledge. One of the guys had a sizable investment portfolio, and he was being asked to pledge that. We were able to get around that for him.
And so generally you're going to do your best to, I mean, you're always going to do your best to keep it within the company and not make it personal, I would think. I mean, that's what an owner would want. That's what I would want, you know,
Yeah.
keep it off of my house if possible. Maybe that's how I started, but if I have a buyout that helps pay that off and I work and it moves everything into my corporation instead of my personal, that would be the steps I would want to take. From there, that makes perfect sense to me. Interesting.
It's always for us. It's about relationships, right? We're not looking at this on a transactional basis, and when that's how we set ourselves up from brokers. If somebody comes to us once, we know they're going to come back to us if we do it right. And we've been fortunate that we've had some repeat clients coming back to us to do business.
Excellent. Now, let me ask you a question to switch gears just a little bit here.
Mm-hmm.
We're a technology company. How have you
Mm-hmm.
seen technology change in your space over your time, in the banking or maybe focus on the finance world?
Wow.
Depends
Uh, you know,
on how far back
it's
you want to go.
it's
Okay.
been it's been well, no, it's not so much that. It's the real breakthrough um has been when, give me a minute to kind of
No
put
worries.
this together in my head because it's an exciting piece for me. After all these years of hearing about these breakthroughs and everything else, the banks I worked for, they were sophisticated in some senses and not in the others. Okay. And I'm not a part of the banking anymore, so I don't know how they use AI nowadays. But I will tell you from my perspective, a lot of the platform we built, if we didn't have AI, would have easily taken us 2 years. A lot of the
Yes.
analysis we do, and I don't take financial statements and throw them into AI and say, tell me what you see. I took a blank spreadsheet and said, I want this to do this. Okay. And working with AI, I was able to get it to perform the way I wanted it to perform. I'm not a programmer. Okay. I know how to put in, formulas here and there. Like I know how to say, add this column and add that column or sum all of this, right? That's easy.
Right, right, of course.
What I never realized was what you could do with programming in Excel. AI opened my eyes and taught me how to program a spreadsheet. So now when I want to add something, I get this little drop down box that shows up on the side, and everybody that's a programmer saying, what are you, an idiot? You never saw that happen before? Well, yeah, when I was using programs that were out there, but now this is a program that works for me
Right.
based on what I asked AI to do. And it works for my clients based on it's not a prepackaged program that does maybe 85% of what I wanted it to do. And then I got to go find another piece. And that's what happens in financial institutions, right? A program will do a percentage of what you want it to do, but then they got to go buy another piece to do the other percentage of what they want it to do, or a
Right,
third
right.
piece to do
All the
another
add-ons.
percentage. And now you're starting to compile different pieces. Whereas with AI, I was able to say, okay, I got that. Now, how do I add this piece to it? And it was like, it was mind boggling. It was mind boggling. So to talk about technology, that was a huge boon for us because I would have had to probably send that out to God knows where and go back and forth with a programmer, let's just say it was India where it would have had to go, right? And now I've got it coming back the next morning and I look at it and say, nope, that's not it. So now I got to send a note back,
Right.
boom, maybe they respond at night, and they fix it and it's 2 days later. Whereas with AI, in 3 days, I had this thing working the way I wanted it to. So that part was incredible. Now I know what it can do, right? Meaning now I know what these spreadsheets and these various programs can do. The other part of it is the research is 100 times better, right? I can go into AI and say I need an app that does X, Y, and Z, right? So it'll go out and in minutes find the apps and it'll bring it back and I'll look at them and within an hour I can say, nope, that one doesn't work. This one does, that one doesn't.
Yep.
and then move on from there. Whereas I could Google that, right? I could go in today and Google it, and I could get 300 companies. And of course, the ones at the top are the ones that pay for advertising. So,
Yeah. It's changed everything, hasn't it? I mean, research is
yeah,
a
it
great
has. Now
example of that.
I can tell you, you can dump in financial statements and you can ask it to do an analysis. But where I find is it's very generic analysis, right? It's
Mhm.
very generic. So if I go in, I put in the analysis that I did and I say, this is what I'm seeing. Do you confirm it? And, this is part of the fault. Sometimes it'll say, yeah, I confirm what you're seeing when it shouldn't
Right. It's a false positive. Yes.
because it's built to be nice.
It
So,
is.
you
Yes.
got to learn how to use it. But to your point, from where I'm sitting as an owner of a company and a newly formed company, trying to get on my feet and not, incur costs that could cripple us, AI has been huge. I mean, I don't know what you pay for, I forget what it is we're paying, but it's
It's not much.
200, 300 a year for, and compare that to farming it out to somebody, it would be 5 to 10 grand for, getting that thing to work the way you want it to. Huge difference. And this is what, in a matter of 2, 3 years.
Isn't that amazing? Yes.
Yeah. Yeah. So, I we can talk about, platforms and things like that. And that has developed. A lot of tech companies have put platforms out there so lenders get on one side and brokers get on the other side and they put their information in and 10 lenders come back and say, here's what I'm going to offer you, here's what I'm going to offer you. I think to some degree that's caused more harm than good because, basically you're putting in some numbers and somebody's spitting back a response. And then when they get into the nitty gritty, they're always going to want to see financials at some point, certain things. And then it's a no. So all of a sudden the client's frustrated, right? There's no human interaction.
Right.
Okay, so what we make certain of is when somebody comes in, you're not going into our platform. You're talking to us first. You're giving us the information. We're putting the information in, and then the platform's spitting something out. And then we're looking at it and making sure, based on our years of experience, to say, this is the direction we think you should go in.
Yeah. I think to your point, going down the road through the, I don't know what they call the platforms where there's going to spit out options. You could do that for consumer finance, all you name it. It's there, but they're going to want to drill down to what the real deal is. And there's no experience as part of that. It's just using those numbers, no perspective on, hey, this is the type of company this is. We know it fits better over here. That debt stack makes no sense based on what they're
Mm-hmm.
trying to accomplish because not maybe not even looking forward, right? You got to have a person with intelligence and experience behind that. And can you train that into the systems? You can't. I don't think you can train them into the systems. Maybe AI assists in the future if it's trained. But as when we deal with AI and AI, SDRs and different. Sorry, I got weird and technical there, but we've got to train
Mm-hmm.
that thing to where it knows what it's doing based on your type of work. I don't know that you could do that with initial information or even, complicated, full financial statements. It needs to know the perspective, and I don't
It's
think we're anywhere near
really,
that yet.
yeah, it's hard to do because what you're asking is somebody like me or my partner to develop the AI to do our job, as
Yes.
opposed to
Just
using AI as a tool to do our job better. And
yes.
that's where I think look, I can put in a lease into AI and I could say, hey, I need you to comb through this. Like,
Right.
over the
Abstract.
years, I can take a lease agreement and I can comb through all of the BS that's standard legal mumbo jumbo, right? I want to get to how much are they going to pay you? Is it triple net? Is there
Right.
anything in this lease? What are the out clauses? What is the this? So now I can put that into AI, and instead of trying to fish through that and see something like that or potentially miss the default clause that's buried in there, AI will do all of that. And then
It's
what I
very
tend to
good.
do is say, point to the specific paragraph and give me the exact language to make sure that AI is reading it the way I read it. And so
Yes.
that saves a lot of time and effort and energy. What I think we're I think, my feeling is, I should say, what I
Okay.
sense is that they're looking for AI. What I'm feeling is that AI is looking to be replacing people, and it shouldn't. It should be used to train people. You know, I have a 22-year-old son, and I could train him. I could use AI to train him to do what I do, and his learning curve would be a lot faster than mine was at his age.
Yes, I agree. It's going to just move us, and it's already moving us faster. And for it to do the training, it has the information. As long as we give it the right information and the right context for the training, absolutely right. And your use of it that you were talking about before, for it to walk you through and train you as you went, to create, a template, and then you knew how the template was built also, right? Because you were right there, developing this thing. So you're giving it the smell test based on your experience also. So that's
Right.
always going to be how that would work. So
If I'm
that's
a
very interesting.
coder, let's just say I'm somebody who codes for a living. And you know how to code something. Like if somebody like me comes to you and says, I need something to figure out how this spreadsheet works, you plug what I want into AI, it's spitting out a code, right? And you
Yes.
can give that to me in minutes. And it can tell you he's looking for, the current ratio, which is calculated as X, Y, and Z, right? Like when I look at a code, it looks like a foreign language to me. But
Right.
when AI explained it to me, this code is just telling it to do this. I'm like, oh, really? Now it makes sense because it's not symbols. It's a word. It's just saying get
Right.
this over here, right? So if the coder knows that I want this formula for this reason, AI can explain that. And that's what I mean by training and enhancing knowledge. And basically, it bridges the gap between what I'm trying to do and what they're trying to do for me. And think about the cost reduction, right? In terms of time.
My gosh, efficiency. I mean, that's one of its number one uses is efficiency. There's no question
Right.
about it. Yeah.
Right.
Yeah.
Right.
So, Emilio,
So,
we're going to have to wrap up here, but we've not talked about you personally at all. Just give us a background of what you like to do when you're not working with clients.
well, my number one passion that I developed, it's very costly, but it's been golf. I mean, besides my family, obviously, but I love to golf and I'll be out on the course as much as I possibly can. The one benefit of moving to Texas is I can do it all year round.
Oh, yes, right. Yeah.
When I was in Connecticut, I would have, at this time of year, I'd have been in a bad mood.
So, Emilio, you
Besides
are in the
that,
right place. Yes.
my wife and I are trying to just ride it out into our sunset years. We got two wonderful kids. My daughter is living in Massachusetts. She's a teacher. My son is down here. He graduated last year. He's going for his MBA. So he's trying to find something in sports management, so he's living with us right now and finishing up his MBA. My wife is a teacher as well. So, it's not the easiest profession in the world. It's crazy, but I
Yes.
admire them for doing it. I really
Yes.
do. But if other than spending time with them, I'm spending as much time as I can out on the golf course and losing golf balls. AI cannot help me with that. I
Hey,
can
can
tell
I
you that
help you
right
with that
now.
right now? No. No, not yet. We'll see. We'll
I
see where this
wish
goes.
I wish it could. It doesn't have, the robot arm doesn't come, that you can strap it on and,
No,
and
it's
hit
not.
it.
Yeah, I don't have any chips that help me swing better either. So yeah, there's not yet. We'll see how it goes. So
Yeah.
Emilio, if someone wants to reach out to you and engage and have some consultation, how can they
Sure.
reach you?
So, we have our website set up, www.alliancecapitaladvisors.net. You can hit the contact us, and it'll send us. It'll ask for some brief information. You can email us at info@alliancecapitaladvisors.net. That'll come to me or my partner. You can call me directly at 860-878-8945. If people want to, I would ask them to follow us on LinkedIn. We're Alliance Capital Advisors USA on LinkedIn. We have a YouTube channel as well. We'll see your smiling face on there once this is done.
Yes.
And, you can follow us on LinkedIn and Facebook as well.
Excellent. Excellent. Well, for those of you watching, if you got value from this episode, be sure to follow Technologies Now, the Business Edge on YouTube and LinkedIn as well, of course, where we break down the systems, strategies, and decisions that help entrepreneurs build smarter, stronger businesses. Emilio, thank you for joining us. It's been a pleasure.
Well, thank you. The pleasure's all mine.
Excellent. Okay.